UTI Nifty Midcap 150 Quality 50 Index Fund. This is a new NFO. Will this NFO help you create long-term wealth? Do you have to invest in this particular NFO to achieve your financial goals? Let us review this NFO. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. Before going into the details, first let us understand the key features of this particular fund so that we can analyze and evaluate this particular fund in detail. This particular NFO is an index fund which is going to replicate Nifty Midcap 150 Quality 50 Index. So they are going to mirror and replicate this particular index. The NFO is open till 5th April 2022. Minimum investment in this particular fund is just 5,000 rupees. And because it is an equity fund, SEBI's riskometer says it is very high. It is an open-ended fund. You can enter anytime, you can exit anytime. Subject to the tracking error and the expense ratio, this fund will try to generate similar return as of Nifty Midcap 150 Quality 50 Index. Let us understand few important facts about this particular index. The Nifty Midcap 150 Quality 50 Index includes top 50 companies from the Nifty Midcap 150 Index. See, in the overall stock market, top 100 companies are classified as large cap. Next 150 is what classified as mid cap. Out of this 150 mid cap stocks, based on some predetermined quality scores, they will select 50 companies, and this 50 companies constitutes this particular index. The quality scores given by National Stock Exchange are like return on equity, EPS, financial leverage. Based on the past 5-year data, they will be doing it. The weight of each stock in the index is based on the combination of stocks' quality score and the free float market capitalization. So this is simply an index fund. There are few filters are added to it. One is return on equity and the other one is EPS and the financial leverage. These are the basic filters used, very basic filters based on which 50 stocks are selected out of total 150 stocks. This particular sector represents many sectors like consumer goods, IT, industrial manufacturing, pharma, chemicals, oil and gas. So this is completely a diversified fund. This index is diversified into multiple sectors. This is not a concentrated sector specific index. No, this is completely a well diversified index. What's the past return of this particular index? As on 20th February 2022, in the last 1 year, this particular index has delivered 18.55% return. Last 5 years CAGR return is 16.45% return. Since inception, this particular fund has delivered, means this particular index has delivered 19.75% CAGR. Being an equity fund, this fund will deliver returns in the long run, suitable for long-term money and not suitable for any short-term investments. Top 10 constituents of this particular index is Page Industries, Tata ELXI, Crompton Greaves, ICICI Securities, Mindtree, Bharat Electronics, Voltas, Emphasis, Supreme Industries, Astral and all. This is the top constituents by weightage. So now, like, we have understood the basic structure of this particular fund, and also we have given you the background and an outlook of this particular index, past performance of the index. Now is the time to go into detail and evaluate this particular fund. So now we will evaluate this NFO. First, understand what are all our key observations which are in favor of this fund. Pros of this fund. Advantages of investing in this NFO, let us find out. This fund has a diversified portfolio, diversified into multiple sectors. This fund is suitable for aggressive investors looking for mid-cap exposure. If you are looking for very conservative portfolio, only large cap stocks, defensive stocks, then this is not for you. If you are looking for aggressive mid-cap portfolio, then this may be one of the good options you can consider. This fund is free from fund manager bias. There is no stock selection risk because the fund manager is not doing any research, not analysis. The index itself, based on 2 or 3 basic filters, they have selected 50 stocks from 150 mid-cap stocks, and that 50 stocks are blindly followed by the fund manager. The fund manager is not picking and choosing any stocks. If he picks and chooses, there can be bias. He may do some mistakes. His judgments can go wrong. This fund manager bias or stock selection risk is not there because he is going to buy the entire 50 stock index he is going to buy. Then this fund is basically for long-term investments, not for short-term investments. Being an equity, this has got a potential to give capital appreciation in the long run. Because it is a passively managed fund, there is no fund management expenses or very meager fund management expenses. This fund will have low expense ratio. The cost will be very low compared to an actively managed fund. We have understood what are all the pros of this particular fund. Now, when we did our research, what are all the points which are against this particular fund? What are all the disadvantages? What are the potential demerits of investing in this fund? What is the risk that we have to understand? Let us list down our observation on the risk. This fund is not suitable for investors who are very conservative, because it is investing in mid-cap companies. It is, mid-cap companies are less stable when compared to large cap stocks. These stocks are more volatile compared to large cap stocks. So it is not suitable for ultra conservative investors. No. Being an index fund, because of the tracking error and the cost expense ratio, this fund can underperform the respective index. Being an index fund, this will mimic and replicate the index. Whereas in the actively managed fund, the fund manager will choose the best stocks out of index based on his own analysis. So there's a possibility the actively managed fund will outperform the index fund. The actively managed fund has got the higher potential to give market beating returns. This fund will not give market beating returns because this is going to simply mimic the index, mimic the market. Based on the market outlook, the fund cannot change the allocation dynamically. This fund is limited to mid-cap 50 stocks based on the quality parameters predefined by the index. So if the outlook for large cap is good, they cannot move to large cap. If the outlook for small cap is good, they can't move to small cap. Even if the outlook for mid cap is not very bright, they have to stay invested in the mid cap stocks only. So dynamically, they cannot change the allocation between capitalization. It is not possible. Some basic filters are used to select these 50 stocks predetermined by the exchange for this particular index, and also based on the basic quality scores and the free float market capitalization, the weightage is decided. So the fund manager is not doing any in-depth analysis of this particular fund's stocks. He will simply buy the entire 50 stocks, blindly buys the 50 stocks which are predetermined based on basic quality parameters. So he will not do any updates. Say out of these 50 stocks, if there is some bad news for one of these stocks, the fund manager cannot exit, right? So if there are like good news for one of the particular stock and the potential for that particular stock seems to be bright and it can give much better return, they cannot increase the exposure. It is practically not possible. They have to mimic the index, same weightage. They cannot increase or reduce the weightage between the stocks within this 50 also. It is not possible. So fund manager will not analyze the balance sheet. He will not look at the profitability. he will simply blindly buy the 50 stocks in the index. Active funds in comparison has got the higher potential to deliver returns because active funds, the fund manager will do a lot of analysis, in-depth analysis. He can even visit the company and sit with the top management and understand and then decide to invest or not to invest. He'll be able to decide. Those kind of analysis or visits to the company is not done in this particular fund. So because of that, actively managed funds have got higher potential to deliver better returns than this fund, and actively managed funds can take better calculated risk. Comparatively, this index fund takes blind risk. Tracking error is one of the drawback of this particular fund. When the market is going to correct, right, fund manager can change the stocks into defensive stocks in an actively managed fund. Whereas in the index fund, even if the market is going to correct, the fund manager cannot do anything. He has to simply follow the index. When the market is going to recover, the fund manager can change the portfolio into growth stocks, momentum stocks in the actively managed funds. Here it is not possible. So based on the market outlook, the fund manager cannot take any position in the portfolio. Whether the market is going to correct, the market is going to recover, he has to blindly mimic the index. So these are all the disadvantages of this particular NFO. Let us understand the final takeaway. As an investor, do I have to invest in this fund or I have to avoid this fund? Let us figure it out. To avoid or to invest in this fund, to decide, we have to first understand what type of investor am I. It depends upon you as an investor. You have to select or deselect this fund to invest. If you are an aggressive investor and you are not willing to invest in actively managed funds, then this fund can be one of the consideration you can make. If you are an investor who is looking for exposure in large cap or exposure in small cap, then obviously this fund is not suitable for you. Long-term investments in actively managed portfolios can provide better returns. So if you are someone who's capable of selecting actively managed portfolio, or if you have a reasonably good financial planner who will help you select good funds, then like your circle of competence is good enough to select actively managed funds, then you can go for actively managed mid-cap fund instead of this particular index fund. There are existing similar index funds with less expense ratio and less tracking error. Whereas this particular funds, ability to maintain low tracking error and the ability to maintain less expense ratio is yet to be tested. It is not tested. So it is not a proven fund in these two criteria. So instead of risking here where it is not tested and proven, you can go for funds which are existing, which are tested, proven with low expense ratio, low tracking error. You can choose those kind of funds instead of this NFO. If you are someone who is looking for market beating returns, you have to avoid this particular fund. Right? So it depends upon what kind of investor are you, and depends upon your ability to select actively managed mid-cap funds. You can select or avoid this particular fund. Do you have any questions related to this particular fund or any other investment options or financial goals? Feel free to book a free appointment with our financial planner. The appointment booking link is given below this video in the description box. Would you like to attend insightful investment webinars? Then the registration link for the upcoming webinar is also available in the description box. Feel free to book your seats for our upcoming webinar. You will learn good long-term wealth creation mantras there. If you are not subscribed to our YouTube channel, take time today now and subscribe to our channel now so that you will not miss any of our future videos. Bye.